It's April 11th and time for our first quarter review and market outlook. So investors were taken on a wild ride through the first quarter. However, the second quarter is starting within shouting distance of the year's starting mark. If one were to just look at the starting and ending point for equities, you'd really wonder what the fuss was all about. We saw ramped up fears of both global and domestic recession, pushing stocks substantially lower into correction territory. But on February 11th, a rally ensued that brought back equities to within shouting distance of the flat line for the year. Recession fears faded with better data. The sentiment was aided by a dovish Federal Reserve meeting that saw a forecast for rate hikes this year move to 2 from what they had talked about earlier was 4 times. Commodities also staged a nice turnaround, aided by flattish to slightly weaker U.S. dollar, while oil and stocks continue to trade in a pretty tight lockstep. Last week, the rally resumed, climbing 1.8%, although expectations for the upcoming corporate earnings season are still pretty low. Investors have chosen to focus on the positives. Specifically, investors reacted to the dovish comments by Federal Reserve Chair Janet Yellen, which counteracted some of the more hawkish comments by the Fed officials the previous week. Other asset classes came under pressure, including commodities and oil, and causing some skepticism about a market rebound. The oil sell-off was due to heightened doubts about the ability of major producers to formalize a production freeze agreement. And just as an aside, today we learned that oil prices were up pretty sharply, with the market up over 100 points, really based on maybe there's a production freeze agreement ahead. So some of the top themes. Number one, the strength in the labor market has reinforced our view that the economy remains in solid shape. The March jobs report was pretty good news. Payrolls were up by 215,000 last month, and the unemployment rate ticked up to 5%. This data suggests that more Americans are entering the labor force, climbing 0.3%. although they're only up 2.3% for the quarter on an annual basis. Overall, the data suggests that while the economy may not be accelerating rapidly, it is certainly growing. And then, secondly, manufacturing may be finally shifting into a higher gear. The March ISM, which is the manufacturing index, beat expectations by rising from 49.5 in February to 51.8 in March, and any number above 50 indicates growth. This was the highest level since last July. New orders showed a particularly large increase, and we think that the stabilization in oil prices and the decline in the dollar are improving prospects for this manufacturing section. Third, the Fed is likely to remain cautious in its rate increase efforts. Janet Yellen's comments indicated that while she acknowledges improvements in the economy, she is also focused on weaker international growth. So the Fed is in no hurry to raise rates again. Most people expect one increase this summer and probably one increase later in the year. Conversely, Goldman Sachs chief economist suggested that the Fed would raise rates 3 times in 2006. Fourth, we expect the first quarter real gross domestic product to be about 2%. The economy is enjoying a number of tailwinds, including low mortgage rates, healthy consumer income growth, and low energy prices. However, weak growth overseas has been a drag. And finally, fifth, near-term weakness in corporate earnings may persist, but the results ought to improve later this year. We're just starting to see the first quarter earnings come out. We anticipate the numbers will show a year-to-year decline. We believe that the corporate profits are bottoming and expect to see better results in the second half of the year as the headwinds fade from the oil down, dollar up dynamic. So the U.S. consumer, which has been the linchpin of the economy, continues to look pretty healthy with, as I mentioned, low energy prices, low unemployment, higher wages, and reduced debt. They are also maintaining a deleveraging mindset, which suggests only modest U.S. economic growth. Housing has been a strong point, but has recently shown signs of leveling off a bit as existing home sales fell 7.1% in February, but did rise 2.2% year over year. Mortgage rates remain historically low, and data shows that, although delayed, the younger generation is increasingly looking to settle down with families and buy homes, which should continue to provide an upward push to housing. So taking a look at our portfolios relative to the market, our conservative accounts are up 0.18% during the quarter, with the moderate accounts down 1.1%, and the aggressive accounts are also down 1.35%. Conversely, the S&P was up 1.09, and the Dow was up 0.91, while the total market index was down 0.93. So pretty flat all the way around. The negative number in our portfolios really reflected the weakness in the small caps and developed international sectors. Healthcare was hit particularly hard as a result of the negative comments by a number of the presidential candidates. We did make a couple of changes in our portfolios during the quarter. In the conservative accounts, we sold our position in Matthews Growth and Income, which was about 5% allocation, and bought Ridex High Yield Fund. This 5-star rated fund has been ranked number one among high-yield bond funds for the 3 and 5 year period. As of April 7th, it was up 3.66. Its success really is the result of a strategy of avoiding sector bets, particularly in energy, which has been the bane of the high-yield bond sector in general. In the moderate accounts, we liquidated our 5% position and added 5% to Metropolitan West High Yield, which we have owned for some time, and that's a pretty conservative high-yield bond fund. Our allocation in the moderate accounts are now 35 to 40% domestic equities, 50 to 55% multi-sector bonds, and 15% in international equities. Finally, in our aggressive portfolios, we also liquidated our 5% cash position and bought a Diamond Hill Mid-Cap Value Fund. This Mid-Cap Value Fund has outperformed the S&P in the Mid-Cap Value Index in its short history. Of particular note is its positive downside capture ratio relative to the S&P. In other words, it was down 26% less than the market during the negative periods. We have always followed the opinion of Ed Yardeni, and as of last week, he feels that corporate earnings would increase 2.2% this year, pretty much in line with the projected growth in the gross domestic product. However, he thinks that earnings will increase 13.7% next year. His 2016 target of 2,000 for the S&P has been exceeded already this year. He is still targeting 2,200 for 2017, and he remains a secular bull. Ed really focuses on forward earnings forecasts, and he thinks that forward earnings will remain flat throughout the summer before trending higher again, though at a very gradual rate. Funny remark about what's happening politically. I think a contributor to some of the volatility is the result of the rhetoric from both sides of the aisle as we head closer to the November presidential election. While this may be discouraging at times, I think it's important to resist the urge that think all is lost or believe that those who say it's never been this bad. According to the Republican National Convention, there have been two hotly contested contests in recent history, neither of which resulted in the dilution of the party, while the Democrats managed to survive their very turbulent 1968 convention that at least partially contributed to riots in the streets of Chicago. Just when things seem like they can't get any worse, Remember 1804, that's also the subject of the hottest show on Broadway, when a simmering political rivalry, which featured a lot of name-calling and insults, does that sound familiar, resulted in a duel with guns that saw a sitting vice president shot and killed a former Secretary of Treasury. And the U.S. managed to prevail through that as well. So the point is, stay calm until we have the two final candidates, each of whom will put forth actual policy proposals. We believe the election will not be a major market volatility contributor. So finally, the bottom line in our view is that the global economy remains rocky and is still dependent on supportive monetary policies. In the near term, equities, as we mentioned, may experience some consolidation given the extreme pace of recent gains, but we don't expect to see a sustained uptrend in equity prices until investors grow more confident in the global economy and become convinced that oil prices won't experience a renewed rout. Nevertheless, we believe that global growth conditions will improve as the year progresses, which should provide more support for corporate earnings and allow equity prices to rise. So as such, we continue to have a moderately constructive outlook and a favorable view on a 6 to 12-month basis. Finally, a note, it's been nearly a year since we opened our office in Centennial, and some of you have stopped by to meet Peter Johnson, and some have added Peter's investment strategies. He utilizes long-term individual value stocks in addition to tactical trades in different sectors and as well as cash. We call it our hybrid strategy. You can find more about it on our website, or you can give us a call or even stop by. So that is it for the quarter, and have a great spring, and we will talk to you in the summer. As always, thanks very much for